everybody. Episode number 26 of the Modcast with special guest Dave DeVoe from DeVoe & Co. So excited about this one, Gary. How about you?
Yeah, I'm super psyched, as we like to say here in California. Dave, it's great to have you.
Calling in from Miami. Yeah, it's good to be here.
Nice.
What's happening in Miami? What's the story?
It's pretty hot here, Gordo. I'm not going to lie. I was told it'd be perfect weather every day, but it's a little humid, so I'm working through that. I think I've been here 2 weeks now, and it's been, I wear shorts a lot outside.
Yeah. All right. So just catch us up, right? So you shared with Gary and I the big news. It's a couple of big events in your life.
Oh, yeah, absolutely. I assume you're alluding to me getting married. So I'm all grown up now. My lovely partner of 11 years. We got married in Croatia about a month and change.
Congratulations.
Right. Yeah, Croatia. What a beautiful place. Beautiful, as we've talked a lot about. All right, so that's one. And then what's the next piece of big news from Dave DeVoe?
Yeah. She decided, hey, if we're gonna get the tax break for 2026, we got to move right away. So we got back from our wedding and packed up all our stuff, and we moved out here to beautiful Miami. So it's beyond the tax reasons, but it's good to be here. It was a heck of a lot of work, so we'll need a break pretty soon here.
Yeah.
And all for any California tax officials watching the Modcast, which I'm sure there are many, Dave is definitely recording this from Florida. He does not work in California anymore.
That's right.
You can see some Miami buildings right there.
There you go. Yes.
Yeah.
Unlike Gary and I, who refuse, I just look at it as a resort fee. California's tax. It's just it's a resort
way
fee.
To think
yeah, there's no humidity here. We're in Laguna Beach and it's beautiful out. But all right, hey, we're going to hop into the Modcast. The reason we're here today is Dave every quarter puts out the deal book. I love to read it. Unfortunately, Modern Wealth is not listed in this quarter's deal book. We've actually gone 0 for 2 this year, but we're going to get into that. It's a little thing we'll talk about because we have been quite active. We have done some deals, but they don't show up in the deal book. But we'll get to that. We'll get to that later. But we're going to talk about the deal book. We're going to talk about Q1 and the barn burner that was for M&A activity. We'll talk about Q2. And it was quite soft relative to Q1, but still set a record per the book.
Yeah.
We'll talk about talent. We'll talk about organic growth. We'll talk about value drivers of an RIA and building an RIA and like how do you get the most out of your life's work when it is time to transact. And we'll talk about other stuff, just stuff that comes up along the way. You ready?
I'm ready. Let's do this.
It's awesome. All right. So the M&A Q2 deal book is about to land. Gary and I got a sneak peek. It'll be out by the time this is produced. But give us the highlights. What happened in Q1? And then what were you shocked by in Q2?
Yeah, absolutely. So Q1 just we blew the doors off M&A. And the context, we've had over 10 successive record years of M&A activity, one year bigger than the next. And we saw that in Q1, a huge surge of activity. As you mentioned, a little, a material slowdown from Q1 into Q2, but it's still the strongest Q2 we've ever had on record. So what does that do? You put those two together, and it's the biggest first half of the year we've ever experienced, about 13% higher than we've ever seen. M&A is hot. M&A continues to be hot in the industry.
So you're saying it's up 13% year to date over last year?
Yep.
Wow.
And last year was a record, and the year before was a record, and the year before was a record. Right? So.
Yeah, I think what was it? I think about 3 years ago, we had a slight decline, and the reporters then came and they thought, hey, back in 2023, we went from 264 deals down to say 251, and the reporters were asking, can't blame them for thinking, is the party over and now M&A is going to decline? I told them then, absolutely not. We got some interesting dynamics that are happening in the marketplace, but just based on our assessment of this wonderful industry that we're all a part of, some of the underpinnings of it, there's going to be a compression here and there, but we expect we'll see another 5 or even 7 years of heightened M&A activity in this industry. There's just dynamics that are going to drive that for years to come.
So you think that we'll continue to see increasing levels of volume from here, or more like we're now at a level that we should expect this is a kind of a consistent way, or are you saying it's going to continue to grow?
I think it's going to continue, Gary. And I'll go to an extreme. I was at American Express in their business strategy group back when the internet hit. That's probably dating me a little bit, but that internet wiped out all of the travel agents over the course of a couple of years.
Yeah.
It was a profound shift, and it wiped them out. In this industry, we have record M&A activity that we've alluded to. Sometimes people say there's consolidation in the industry. It's inaccurate. There's not consolidation in this industry. Are we at record levels? Absolutely. But every time a firm sells, about 1.4 firms breaks away from a Merrill Lynch or a Morgan Stanley. We have this migration of folks from the wirehouses and other parts of the industry into the independent wealth management space. So this replenishment is occurring. Now we are seeing consolidation at the top. So Modern Wealth is Exhibit A of an organization where that business model of going out and making acquisitions and doing it well and rinse and repeat, organizations like yours that are doing 2, 5, even 10 plus transactions a year, those organizations are growing faster than the rest of the industry. There's about 24 firms that we call meta RIAs. They're using the most effective tactics available to win the game. This is actually from online gaming, Fortnite. I don't know if you guys have kids that are now 21, and back in the day we were about 15 when meta was hot. But that's where I stole it, is from my son's meta conversation on this guy who was really good at Fortnite. Same concepts. Rather than the most effective tacticals to win Fortnite, there's firms that are using the most effective tactics available to win the game of the wealth management space. And also meta being a nice, sort of Greek word for comprehensive. We see about 24 firms that are not only larger and growing faster, they're starting to shape the space, differentiated business models backed by private equity. More importantly, almost unlimited access to capital to go do great things. Sophisticated management teams like yours. We have this set of organizations that is really doing things really effectively, and they're starting to really raise the bar of competition for the space and really improve, I think, how wealth management is delivered.
So, Dave, real quick, we talked about the report, but can you let's take a step back. All right, so we're on a record pace of M&A activity in the RIA space today. What are you counting? We're getting to my pet peeve, by the way.
Yeah. Fair enough. I see where this is going. So we are counting SEC registered firms. We clean out all the hedge funds and those that are not really, wealth management companies the way the three of us think of it. But we're only tracking firms under 100 million. So we might want to come back to
over 100.
Yeah, over. Did I say under? So over 100 million. And we love firms that are under 100 million. We're big proponents of all shapes and sizes of this industry. We passionately believe that the independent wealth management model is the very best way to have U.S. families and individuals have better lives, sleep better at night, plan for the future. But we are nerds. So with that pyramid that we have in this industry, once you get into under 100 million, it's harder to track those deals. We know about every $1 billion transactions, $500 million, vast majority of those 200. But the pyramid above 100 million is about the same size as below, and there's just not as good data. So you are absolutely correct. And Gordo, what could the implications for a firm maybe like Modern be, where we draw the line at 100 and only report at firms over 100 million?
Well, here's my. By the way, I tease Dave. We are on an industry board together, and we see each other at his 2 conferences every year, and other opportunities when those become available to us. We see each other, and I'm always, like, we have done 4 transactions this year, 3 of them over $1 billion, yet we don't show up in the book. And the reason is, I believe, as I've shared with you, there is shadow M&A activity going on that is equally as big in our industry that doesn't get reported on in a deal book like this, and that is people breaking out of a broker-dealer backbone, right? They're coming out of an IBD, or they're coming out of some other entity, not a breakaway out of a wire, but this is maybe somebody who had their own RIA, but they're on a broker-dealer chassis, and that doesn't get picked up in your report.
Correct. And that's really important. That's an important trend, right? Whether someone's breaking away from a corner office or coming over from an IBD, clearly critical for your organization, but it's also representative of a healthy industry. People are moving to better models. People are leaving the wirehouses to come into this space. So important things that we just have to draw certain lines on how we track things.
Right. Yeah.
So within that, I mean, there's a lot of really interesting insights in this report, and I would like to dive into a couple of them. Let's talk first about who the sellers are, the composition of the seller universe. So, and I'll ask you a specific question. From your report, you highlight that there's a trend towards larger RIAs being the RIAs that are transacting, and you point out that in 2023. 50% of all seller RIAs were in the $100 million to $500 million category, but that's now down to year to date 32% of RIAs that are transacting are between 100 and 500 million, and the volume is tilting towards 500 million and up, and especially in the billion plus category. So I realize I just summarized what's in your report, but tell us about maybe some of the why behind that, or what you're seeing in that data.
Yeah, absolutely. So, there's a couple things. One is it's interesting how, this part of the market has really compressed. It's compressed from a percentage basis. We've gone from about 50%, half the transactions in the industry being sub 500, 100 to 500, to about a third. That's a material shift, right? Nominally, it really hasn't shifted much.
Right.
Nominally, they're about the same as they were a couple years ago. Of course, we're only halfway through the year and all that stuff.
Right.
But if you go back over that time period, by contrast, those that are a $500 million to $1 billion, 1 to 5, and even the 5 billion plus, especially most recently, has increased to up to surging the activity. So I think a few things are happening. And by the way, for a while, at 50% of the market, we had gone through a period where the smaller firms, increased pretty materially in terms of the number of transactions.
Right.
I think a few things happened. Part of it's related to interest rates. That decline of activity that we saw was driven by the interest rates across the U.S. going up. And most private equity firms years ago predicted that interest rates would go up from the lows that we saw quite some time ago. But I don't think anyone predicted, or most people did not predict the huge increase that we had. That decline of M&A activity that we experienced was really driven by consolidators dialing back their M&A activity. They were crunching numbers, they're looking at it, and they wanted, some of them were even constrained by debt structures. That was pretty common. And the RIAs started picking up the slack. The RIAs were buying smaller 100, 500 million or less firms. When the interest rates went down, the consolidators moved really aggressively, and they drove up that M&A activity. And where are they going to focus? They're going to focus where the firms can move the needle the most.
Yeah, it's very interesting. And in the report, you talk about that shift, that kind of pre-interest rate spike where consolidators were the active buyers, then a spike in rates, now rush in the RIAs doing the lower end of the M&A activity, lower end being smaller firms. And now that has shifted again, right? And the consolidator is there. There was an interesting stat that it caught my eye anyway when I read it. You survey everybody. We're part of that survey community. And how many consolidators are focused on the sub $500 million segment of the market?
Yeah, as a specific part of their strategy, I recall, I think it was zero. Is
Yeah,
that about right?
exactly zero. Exactly zero. Yeah. So the
It rounded
consolidator
to zero
says,
as well.
yeah, it rounds to zero, right? So the consolidator
zero to
community
zero.
says, no, not focused on that. I'm really focused on $1 billion to $5 billion was where 82%, I think it is. You could correct me on that. Wanted to
Yep.
spend their time, but
Yep.
okay, so 0% say that's their focus. How much of the sub $500 million M&A activity are the consolidators actually participating in?
I recall it might have been around 58%.
Yeah, almost
Is that about right?
60%. So I don't want to spend time there, is what the consolidator said. Yet 60% of deals that happen sub 500 million, it's a consolidator doing the deal.
Maybe it doesn't.
Yeah.
Maybe it doesn't require any focus to do those deals.
Got
That's
it.
what they're saying.
Yeah, got it.
Yeah.
Got it.
Yeah.
That's a.
I mean,
it's a
it
fascinating
is interesting.
disconnect.
It's disproportionately higher. Overall, they're doing about half the transactions in today's market. You can't help but notice they say, hey, that's not our focus, but they're doing disproportionately more transactions in that than any other segment.
So when we talk about they, Dave, like you talked about the meta firm, which I love
Yep.
hearing you describe that, and I've had the opportunity to hear that multiple times now. How many theys are there? How many meta firms are you really tracking?
So meta firms being those that are, it's 24 firms that fall into that category that we've identified as having, sophisticated management teams, access to capital, differentiated business models, and they're growing aggressively. There's bigger firms out there, or some of the firms there's large organizations, but they're just not growing faster. We don't consider them meta organizations, which is different. But there's a fair amount of overlap
Are they
from the
mega?
consult.
Is there a mega and a meta?
Yeah, there's mega. There's small, medium, large, and mega. We consider anything over 5 billion mega. And the meta is a different category. It's typically 30 billion or more, but they're growing faster. And then the consolidator category, there's a degree of overlap, but it's a different definition. We identify any organization or any organization where their business model is predicated on going out and making acquisitions of RIAs.
Yeah.
So, any firm that's doing, say, over 4 transactions at a given year, we're like, okay, or they have an explicit business model that's focused on acquiring RIAs, we consider those consolidators. So each year too, like 1 or 2 might move into that consolidator category.
Sure.
Your firm from day one, that was part of it. We're going to grow through acquisition. We're going to merge firms in. We're going to, create levels of greatness by having scale, and that scale can only be achieved through, acquiring organizations.
Yeah. And we'll do somewhere in the 8 to 10 transaction range this year, right? We may make the book at some point, but we haven't yet. It's really.
I think the cutoff half year was what, 4 transactions, and
right.
I'm
And
hearing you guys might
we've done that.
3 or 4.
So we would have had our name in lights, but
That's
bought
okay.
the wrong things, I guess.
We'll do it here, but I think we're a meta. Are we meta?
I think we're
you guys
meta.
are meta.
I think we're a consolidator.
Yeah.
I think we're a lot of things.
All right,
Yeah.
we'll take
Yep.
the meta.
Yep.
So another insight from your report, which will be linked to our show notes and our website after this show, for everyone who wants to read it, is around valuations, which I think is really interesting because valuations are always a hot topic when you're in the transaction market, as we are. But you noted, I think, a couple of trends around where buyers and sellers think things are headed. So maybe give us a little insight into that. What
Yeah,
did you
tease that
uncover?
out.
Yeah, absolutely. So, I think taking a step back, what's the context here? I've focused on RIA M&A activity for, I think, 25 years now. It's like at least 23, dating myself yet again. So
We all have the same date on us, by the way.
Yeah.
right, we're all
Yeah.
sort of the same
Okay.
vintage
All
here.
Yes.
born
What a great
on,
vintage.
a very
Yeah.
similar year.
So, you guys have lived through this. You've been in this industry just as long. We've had 4 record years of valuations. It's never been higher, and it's been pretty steady, despite interest rates and a variety of different things. As a matter of fact, a lot of RIAs in particular thought, hey, interest rates are going down, valuations are going to go up, and it's a natural thing. Its cost of capital is going down. Valuations should go up, but that's not affecting the valuations, right? The interest rates, and we didn't believe it would, and predicted that in an earlier deal book, and they haven't. And you guys see valuations. We're arguably the most active investment bank. We haven't seen them go down. So those valuations have been high for a while. On stage or when people ask me, I've said, look, there's more arrows toward valuations going down than up. They're so high, guys, and we can talk about why they're so high. By the way, the other thing that I don't think is in there in great detail is that it's been the broadest range of valuations in the industry too. So maybe we get into that or not. But I think the interesting thing that you're alluding to, Gary, is a question we ask each year in the survey is and again, this is a survey where we go to the consolidators and we say, a variety of different questions, including, your expectation of valuations. Do you think it's going to hold steady, it's going to go up, or it's going to go down? And, we mentioned a number earlier. The number was 0. Yet again, 0 is showing up, where 0% of the buyers that we surveyed indicated that they thought valuations would go up higher. And that's a material decline. It's an 8 percentage point decline from last year when we did this. And we saw, the category that says valuations will increase even greater. They increased about 11 points. So 82% of professional buyers, consolidators, et cetera, believe that valuations will stay the same for the next year, with about almost 20% saying they'll go down. But this is a material shift from a year ago where, 8% thought they'd go up.
Right.
What about sellers?
And only 7%, I'm looking at your chart, only 7% thought they'd go down a year ago. Now it's 18. So it's at least you have a more meaningful minority percentage that is saying, well, it's going to go down, and nobody's saying it's going to go up.
Yeah, those are the buyers, right? What about sellers? What's seller expectation?
Well, so sellers, we don't ask, we do a couple reports a year and we do a variety of questions. And you know what, especially with this new data, maybe we ask the sellers in the next survey what they think will happen. We do ask the consolidators. We say, are gaps between buyer and seller valuation expectations, widening or narrowing? Are they increasing? Are they getting further apart, or are they getting closer? And this is the first year we've asked this question. Widening was, nearly 3/4 of the answers. Narrowing was 9%, and no change in expectations, a pretty small number, 18%. So the vast majority of acquirers are showing up and they're saying, look, sellers continue to think, and maybe it's related to interest rates. As I said before, so many people I talk to are like, oh, interest rates are going down, so valuations will go up. I'm like, it's not cost of capital. This is the key driver of the equation. So there's that clear, disconnect that exists in the marketplace right now.
Yeah, I think it's also a lot of people hear multiples, right? My friend told me, this is what I'm hearing. And there have been some high multiples paid in the market if you're able to go out and grow your business meaningfully, right? So it's some multiples have been paid that are quite high if everything is accomplished in the agreement. Like, are you able to jump over the moon backwards 3 times over the next 2 years? Because if you do that, you'll get paid the money, right? It's so multiples can be all over the board, and there's different deal structures, there's different deal incentives. And when you pack it all in, if everything is accomplished, yes, that's possible. But really multiples, are one of the most talked about things in our industry, and one of the most confused things at the same time.
Well, I think too, the media, when the ones reading the media, they hear about a rumor for consolidator XYZ or MetaFirm,
Yep.
ABC, et cetera. These massive firms that have 20, 40 billion, sometimes 200 billion or more, they're the biggest firms in the marketplace. And it's pretty rare for a garden variety organization to, hit 20 times. It's such a huge multiple, right? So our valuation's at an all-time high, absolutely. Is a perception in the marketplace that you can fall off a log and get, 25 times the cash flow. Unfortunately, some people believe that, and that's not the case. And I mentioned it too. We've seen the greatest delta in this industry as well. Not only if you look at the valuations paid for internal succession, which I know we all collectively are big fans of. You don't need to acquire every firm on the planet.
No.
We all collectively would love to see more and more firms sell internally. Matter of fact, we might get into it. I think it's a crisis in this industry right now, the lack of succession planning. But the delta between selling externally and selling to a private equity backed firm when you're represented by an investment banker and you're doing everything perfectly, by the way, you have high growth, et cetera, that extreme is huge.
Yep.
But even when we take a seller to market, and we're methodically thinking through their story, we're connecting them with firms that are a really good fit. There's just going to be some firms that will pay a premium for that organization above other private equity backed firms, or clearly the $5 billion buyer down the street as well. There's just a big delta in the marketplace that we can get into more detail on or not.
Well, why don't we unpack that a little bit? So you're saying that in any given sale process you're involved in, that the range of valuations, the range of pricing you see from potential buyer to potential buyer, that there's a pretty wide spread.
Pretty widespread. Absolutely. Yep.
And you attribute that to, maybe just give us a couple of not specific examples, but just generally, like, what do you think drives the high versus the low in a particular process?
Yeah, there's a couple elements, and I think they're all indicative of a healthy industry overall and a thriving set of buyers. So what do I mean by that? And remember, I'm a big fan of internal, so I'm not pushing people to sell externally or sell to the consolidators. But what we have is the most common buyers are the consolidators. These are organizations that have carefully they're seeking to differentiate themselves. Yeah. They're investing in their business, and they have a different business model and a different strategy from another consolidator on the list, which is good. It creates a breadth of options. True breadth of options for any seller to find that perfect fit. These are things that we all want in the industry. When I started, there were like 5 buyers in the marketplace. They're all kind of similar. So breadth of organizations, right? And then let's get into details. I'll make up a couple things. Our job, our number one goal when we're representing a seller is not to get the highest valuation. Our number one goal is to find them the very best fit. Because typically this is not only a business decision, a life decision. People are typically not hanging up their spurs. They're working for 2 or more likely 5 years, sometimes longer.
Yeah.
And this is the final chapter of their career. And you could be miserable for that final chapter, or you can have the best chapter of your career to date. That's how we think about it.
And on that point, you're going to be wealthy no matter.
Right.
You could be happy and wealthy, or you could be miserable and wealthy, but you're going to be wealthy.
Yeah. This isn't selling a house either. You're not moving out. You still got so.
And I think, I think the neat thing about this industry is it's good people, and there's no shame for valuation to be a priority or the number one priority. There's no shame in that whatsoever. But the vast majority of founders in this industry have made more money than they ever thought they would. Have an asset that's exponentially more valuable than they ever thought it would. So it's great, but I've had some buyers that come into this space and they're like, they talk about it, and I find myself cautioning them. I say, these people are not coin operated. It's not just the biggest check that's going to win the deal. So, back to that construct, our goal is to really understand that seller, what their strengths, even what their weaknesses are, what their goals and objectives are, personal, business, everything else. We joke with therapists with spreadsheets. We're trying to figure this all out. And once we have clarity on that, then we're able to, go and match them with a handpicked set of firms. Probably start with 30 that are really a good fit, not just the same investment philosophy or end client size, but hey, this is a firm that's really going to appreciate what you build. As a matter of fact, in some cases, that firm will unlock greater value and power for an organization. So buyer A is like, man alive, this firm has a strength in the market we want to be in, we don't have a flagpole in that neighborhood. We pay a premium for that. They're female led, and that is a high priority for our organization where we want to do that. They haven't overinvested in technology. We got that all covered. Matter of fact, one of their weaknesses might even be growth. We've developed a machine that we think we can grow them well, et cetera. So that organization might pay a completely different valuation from someone who's like, oh yeah, we already have an office there and we're actually at capacity. This will create a bigger capacity problem. We're going to pay a little bit less. Hey, they have, this technology, and it seems like they're so passionate about their investment philosophy that we're actually going to have some friction with that versus firm A, where there's a lot. So all these different factors start to influence, the interest level and what a firm might pay, even where they are in the life cycle of raising new capital. That actually will affect, the likelihood to write a bigger check. So the delta that we've seen when, folks share their offers, and we're not like a big auction house. We don't do the auction thing. Everyone just blast in bids and we'll sort of give you the highest bidder. That really creates that broader delta. And then, by the way, too, if they're these private equity backed firms, like yours, one of the things that, why can firms pay these staggering amounts of valuation? If you're running a DCF, it almost breaks the model, like 17 times cash flow or something, and the reason that some firms can pay so much is they have a business model where they can improve the profitability of the firm in a constructive way, right? So they can make the firm more profitable as they join. They can also help that firm grow faster in a lot of cases. And if you can make a firm grow faster and increase the profitability, you can pay a premium. Oh, by the way, we also have, proof of concept time and again that private equity can invest in a firm, put some magic dust on it, everything goes well, the firm, quadruples in size over the course of X number of years, you sell at a premium and everything's happy. These dynamics make a meta firm able to, or a consolidator, able to pay higher valuations than a great firm that's not backed by private equity, that doesn't have this model. They might have $5 or even $10 billion, but you can't rationale this unlocked value of power, and consequently, these large standard RIAs can't pay as much. Now, some sellers are like, I want a seat at the table. I want a smaller firm. There's 5 other reasons I want to sell to an RIA. Again, breadth of options is great for this industry, but that's some of the data behind what's happening with valuation.
Yeah, and there's a seller there's a buyer for every seller, and not every business model fits with every buyer. And we certainly have passed on hundreds of opportunities that
very
just,
disciplined.
It was either within the first 15 minutes we knew it wasn't going to be a fit, or they knew it wasn't going to be fit, or it was 2 or 3 meetings down the line. But, you talk to a lot of firms when you're in the business that we're in, looking for all the things that you just laid out, like best cultural fit, best business model fit, do the economics work for both sides? How are we going to grow this thing? How do we come together and accomplish big things? Like all that stuff. All right. So let's, I would love to get from you, let's imagine, the listener is a $750 million firm. What are the top 2 or 3 value drivers that they should be, where should they be focused on driving value of their firm?
Yeah, almost every time someone hires us for a sell side, a couple weeks in, we've run them through our 30,000 cell discounted cash flow model, which is really like a diagnostic of the firm. And invariably about that time, 3 meetings in, they're like, man alive, I should have started working with you 2 years ago. Like I can see like how I could have shaped the business and, massively increase the valuation, So, what are the things they could have done if they went back in time, or they hire us tomorrow morning before they sell in 2 years? The number one driver is growth. You mentioned it earlier, Gordo. Gary, I think we've talked about it before. Growth is such a sensitive driver. So a few layers on that. One, for every 1% faster that a firm can grow than its twin, and truly sustainably grow in that fashion, 1% faster, a typical buyer will pay about 7% more. And sometimes people say, oh, so if I grow 3% faster, someone's really going to pay 21% more for me, Dave. And I'm like, yeah, they will. Go call Gordo. He'll tell you where you're, because that growth machine is so critically sensitive to the valuation and the future of the organization. Now, Gary or Gordo might say, hey, tell me about your growth. And if someone's like, oh yeah, no, I'm really good at growth, and I guess it's it's because of my charisma, I guess. We're really good at this. That's going to be quite different than if they say, oh my gosh, let me tell you, 2 years ago, we started playing around with this. We started doing digital, et cetera. We have all these KPIs that we started tracking, et cetera. We also started training our advisors and teaching them how to ask for referrals and also how to network and all this stuff. And they nerd out. You guys will say, hey, the second firm is really where we want to pay for it.
Right,
So
because
punchline
it's
is,
diversified
that
growth.
growth
It's
trajectory is
not.
key.
It's diversified growth. It's not one human dependent.
Mm.
Right. It's not I'm
Yep.
the most charismatic person you've ever met advisor, and I'm going to get all my friends here. So it's diversified avenues of growth, and you said it earlier, sustained. It's not lumpy, right? Where
Ideally a machine.
yeah,
Yep.
it's
Elegant
very
machine.
consistent. Yeah. So organic growth being one. What's another value?
Yeah, profitability can't ignore. That's important, but sometimes sellers just don't understand how that works. So you guys have seen this. We've seen this. Hey, it's time to sell. I've gutted my company, and we're running on a shoestring. And look at the profit. We have like 70% margins, 80% margins. Isn't this great? We're like, you know what? That's not
Pass.
running a healthy business.
We will
Right.
pass. That means you're
What are you
underinvested
guys
in
gonna do?
technology
Yeah,
or
we see that.
marketing or there's somewhere you're dreadfully light on your spend.
Yeah. Now, so healthy margins, we see, the profitability of the firm is almost like a health check. You want strong profit margins. You don't want extreme or inappropriate profit margins, but that's indicative of discipline, someone who's running a well-managed company. And, profitability is what drives valuation. It's not the revenue or the AUM. The profits of the firm are what pay back the investor on the investment. So, that's a critical one. You can't help but look at the talent side of the equation. I think it's the number two reason that buyers in our other survey are saying what they look for in a seller, because this industry needs good people. This is a people business, and you have a strong, you can cut it. Well, I've been talking so much, I'll turn it over to you guys. What do you guys look like when you think about the talent side of the equation and the people? What's important for you?
Well, I mean, it is 100% a people business at every level. And so it doesn't matter what the numbers look like. It doesn't matter what the growth rate is. It doesn't matter what the geography is. If the people don't seem like a good fit, of high quality, and that's obviously in the eye of the beholder. But then there's no structure, there's no price, there's no set of metrics that make a deal worth doing. Period. End of sentence.
Yep.
If the people aren't the right fit. So to us, it's number one. And it's probably the number one, just checkpoint, reference point. You get the numbers first, and you get the profile, but then you're like, okay, let's see what the people are like. We've always kind of had this idea of the dinner test of, are these people that you'd not, it doesn't have to be like, you don't have to want to be best friends with everybody, but like, is this someone you'd be perfectly happy to sit next to at a dinner?
Yeah.
Yeah.
Are you looking
have a conversation.
at the annual meeting? Are you looking for the seat as close to us as possible or as far away from us as possible?
Right.
Because,
Well,
so that's
and I'll
cultural
tell you-
fit is what we're really talking about, is like, do we believe the same things most of the time, right? We don't have to always agree. We can disagree, but how do we disagree? And what's that look like? And will we get along and thrive together?
But I'm also glad you brought up the margin sort of point, because I don't think it gets talked about a lot. But I think something that we've seen as a trend recently in the last year or two is firms being marketed with really high margins. And it's like, superficially, that sounds like it's attractive, but your point is right. Is like, it's a red flag for a buyer, or should be, in my opinion, that like, okay, this is, Gordo uses the term price to perfection, that like, this isn't real. This is not sustainable. Like there is a deferred maintenance aspect or an underinvestment aspect in this. And that's where it gets challenging, because many of those firms, do have bankers representing them who are saying, well, this is what you're going to get. You're going to get priced off of this. And then if you want to come in and be a skeptic and say, well, really, there should be a higher burden on your P&L, like you're just going to get thrown out of that auction process immediately.
Mm-hmm.
Yep.
So
Mm-hmm.
I think there's a lot of that going on, and we'll see how it all shakes out.
Yeah, and I think that's an important point too for sellers as you're contemplating an investment banker. Which, sure, I have a reason to say this, but I mean it's so important. This is, as we've said, the most important business decision of your life, and so many advisors are doing it themselves. Well, one, please hire a banker, and then think about it. Do you want a firm that takes the auction approach and is just the way auction works? It's a multi-tiered auction. Hey, we're going to blast out a standard sim to 200 buyers. Here's some data, make your bid.
Right.
And the top 20 or 30% will make the next round, get a little bit of more data. Hey, make your second bid. And it's very adversarial, et cetera. And firms like yours who have been around the block often are like, all right, I'm not sure I want to participate in this. And suddenly this great firm that could have been a great fit, is off the table.
Yeah.
I think the other thing too is this is all intersected. And by the way, like our whole premise is if we find the perfect partner, they will pay a premium beyond what any auction would have yielded.
Right.
If you guys see the right fit, you're like, hey, wait a sec, we got to go back to the IC, investment committee. We really want to get this firm to join for all these reasons. So we believe that that's actually the way to get the best valuation. But think about all these things intersect, right? So your human capital and profitability. Your human capital is 2/3 of the expense structure. So if you are driving up your margins, you're cutting people, and that can have a variety of negative effects to the organization. I think as you think about people too, it's culture. It's have you underinvested or have you gutted the firm? Do you have the next generation in place? Have you been training your people? Are they good? There's so many aspects, but I think an important thing that I'll talk about too is private equity's part of the equation in this industry. So private equity is now involved in some form or fashion in 89% of the transactions over the course of the last 18 months. 89%. Yeah, it's gone up from about 69%, 2 years ago, a year and a half ago. Good news, private equity has behaved pretty well, for lack of a better word, right? And many of us have read Barbarians at the Gate, or we've seen horror stories. We were around with Chainsaw Al, and these organizations that are buying a firm, they're gutting it, they're levering it up on debt, they're kind of flipping, et cetera. That's not the behavior pattern of private equity in this space. And I think, did they all grow wings and halos and all that? Are they all angels? I think good news, most private equity firms that I know, the vast majority of them, including the people in these, they're not, slimy people that are doing things, but it's also the nature of our industry that they're not doing that. This industry has a deficit of advisors predicted for years to come, and I've talked to McKinsey about it. I think they overestimate it to a degree. I think AI is going to compress a lot of that to 20 or 30%. But we need people in this industry. So, having a good team, a strong team, train people, all these different things. When you join a company, they're not going to gut it. They're really looking to repurpose these people and give them better career paths.
That's right. And I think, from private equity investors we've talked to, if you're going to get involved in the space, you understand it's a people business. There's not property, plant, and equipment that you can, synergize.
Yep.
Or, you can create economies of scale as you grow a firm, but it's at the end of the day, as we said earlier, it is 100% a people business. So the investment thesis is different. It's about growth. So just maybe as a last point on our show, because you've alluded to it a couple of times and it ties into what we were just talking about, you have talked about and written about sort of, beyond M&A, but the succession, I think you have referred to it as succession crisis in the RIA business. So maybe talk a little bit about your thoughts on that and we can discuss it a little bit.
Yeah. We do another survey where we ask, we call it the affordability index. Can G2 or G3, afford to buy out the founders of the firm? and it has steadily declined year after year.
Mm-hmm.
We had a little bit of a dead cat bounce. We went down to less than 20%, and I thought, wow, it's doom and gloom that particular year. Like, just the wheels were falling off the world in many dimensions. And I thought, okay, maybe people are a little negative, and next year it'll bounce up materially, and it really didn't. So we're in an industry right now where only about a fifth of the firms believe that G2 or G3 can buy them out. That's a problem, a big problem in this industry. A growing number two don't know, right? A shrinking number believe, know for a fact that G2 can't buy them out. I can talk about why I think that might be happening. But essentially, many of them are selling each year. So the number that G2 or G3 can't afford to buy out, they sell externally, and that denominator starts to shrink. But this is the concerning thing too, is that big chunk, I think 40% of advisors now don't know. And I encourage people, all your listener, start with the back of an envelope and just think about today's valuation and what'll be worth a couple of years from now. Think about the buying power of G2 and G3. You know what they pay them. Maybe they have a rich uncle or aunt somewhere, but what can they afford? And if it's super obvious that they can afford, great, put that in motion and start selling. If it's completely obvious that they can't afford it, like the mail truck is too far away from the dog's never going to chase it. That's good to know. What do we do now? But if you don't know and it's not super clear, then hire someone. We do a lot of this stuff to gain clarity, because that clarity is so important. And the longer you wait to figure that out, your options shrink. That internal sale becomes challenging, and then it becomes impossible.
Well, not just the internal, the external as well. Both paths become narrow. Like, if you unfortunately, I think the longer you're in the business, the better you get at providing advice to the consumer, to the client, to the people who have trusted you with their life's savings. The longer you wait to sell your business, the less valuable it is, right? So you've got to figure out the succession crisis, which I believe you're 100% accurate in. That next gen crisis that we found ourselves in as an industry is one thing. The second thing is they can't afford the business. So how do you, and if you hold on too long, they're not making progress to being able to afford it. Yet your business, if you wait too long, could be in value decline.
Yeah,
it's just a fact.
Yeah, and also you and many firms would pay a premium for a firm that has good people and a succession plan in place. Okay, great. You're moving toward retirement. We know Lisa or Bob are going to be able to run that office. Fantastic. If you don't have that, then there's actually some buyers that will say, look, we're not buying a problem.
Right.
We don't want to buy your firm and they go find a successor. Like, it's not easy stuff.
No.
So, solving that problem, I think, is great for everyone. It's going to make your organization stickier for all the employees, not just those that could be future shareholders. The others will say, okay, wow, these guys, they're running a better firm, a stronger firm. And it actually creates a gravitational force.
And your firm is not going to be valuable if you're ready to retire. Like, you'll get paid something for it, but you'll get paid more 3 to 5 years pre-retirement than you would at retirement. It's just the way it works. All right. So, hey, our good buddy, Dave DeVoe, thank you so much for your time on the Modcast, episode number 26. We will definitely have you back, because this dude's his knowledge set is incredible. He's definitely worth having on regularly, as long as he would come back.
Kind words.
Yeah. I mean, you're everywhere. You run a growth summit every year in the spring. I've had the pleasure of being there the last few years, and being a speaker.
Well, you'll be on stage in September. We're doing our M&A Plus.
We're doing the M&A one. Yep. So in the spring, it's all about organic growth and next gen leadership and the succession challenge that Dave has talked about. In the fall, it's all about M&A and get a place for you to go and get smart about all things M&A as an RIA. But again, Modcast episode 26, that's Dave DeVoe. That's Gary Roth. And I'm Gordo. We'll catch you next time. Thanks so much.
Thanks for having me.